Many people enter the stock market hoping to get rich quickly, only to suffer painful financial losses because they treat day trading like a casino. Frustrated by constant failures and emotional decision-making, struggling traders desperately search for a reliable method to achieve real financial independence. How to Day Trade for a Living provides the ultimate solution by teaching you how to stop gambling and start treating trading as a serious, highly disciplined profession. Listen now to discover the exact risk management tactics, proven strategies, and psychological mastery you need to escape the 90% failure rate and become a consistently profitable trader.
Wow, that is a heavy opening, but honestly, it is completely accurate. The statistics in this space are just absolutely brutal.
Yeah, that 90% failure rate really hit me right in the chest reading through the material. It is terrifying.
Right. It sounds less like a career path and more like a warning label on a pack of cigarettes or something.
Exactly. But we are here to talk about a book that claims to offer an actual way out of that statistic.
A roadmap, basically.
Yeah. We're doing a deep dive today into How to Day Trade for a Living by Andrew Aziz. And honestly, my first question is this actually possible? Or are we just looking at, survivorship bias?
That is the perfect question to ask right out of the gate. And what is really fascinating right off the bat is the author's background.
Because you'd expect a Wall Street veteran. Right?
Yeah, you expect a guy who grew up on the floor of the New York Stock Exchange shouting orders. Or maybe a hedge fund manager with some pedigree from Wharton.
Right.
But Andrew Aziz actually holds a PhD in chemical engineering.
Chemical engineering. That seems completely unrelated to stocks, unless he is trading chemical companies.
At first glance, yes. But when you get into the text, you see how much that specific background influences his whole approach.
How so?
Well, he treats trading not as an art, not as a gut feeling, and certainly not as gambling. He treats it as a strict process.
Like an equation.
Exactly. In engineering, you have variables, temperature, pressure, flow rates, you have processes. And if you follow the rules of physics, you get a predictable output.
So he is essentially applying that same scientific rigor to the chaos of the stock market.
Yes. He is not promising a get-rich-quick scheme. He is essentially handing us a survival guide.
I really like that distinction.
Yeah.
A survival guide. Because if 90% of people fail, survival really is the first goal.
You can't win if you get wiped out on day 2.
Right. It is not about buying a Lamborghini in week 1. It is about not going completely broke in week 1.
Exactly.
So our mission for this deep dive is pretty clear. We are going to dissect the 10 cardinal lessons from this book. We want to take someone who might be looking at the market like a gambler and show them how to look at it like a professional engineer.
Precisely. This is for the listener who is sitting there wondering if day trading is actually a viable career or if it is just a fantasy sold by guys on Instagram renting Ferraris.
Yeah, those guys are the worst.
Yeah.
And it's also for... We're going to break down the actual business plan.
So let us unpack this. We have to start with the mindset, because that seems to be where everyone goes wrong.
Right. Lesson 1 in the book is explicitly to treat day trading as a serious business, not a get-rich-quick scheme.
It sounds like a cliche, doesn't it? Treat it like a business. Everyone says that.
They do. But what does Aziz actually mean by it in practice?
It sounds obvious, but it is easily the most ignored rule in the industry. Aziz makes a very sharp comparison here. He asks you to imagine you want to open a pizza shop.
Okay, a pizza shop. I am suddenly hungry, but go on. Walk me through the logistics.
Think about what that actually entails. You don't just walk into a random building and start slinging dough.
Right, you have to sign a lease.
A multi-year commitment. You have to buy expensive ovens, industrial refrigerators, furniture. You need liability insurance.
You have to hire staff and train them.
Yeah.
Buy ingredients every week.
Exactly. You are putting tens, maybe hundreds of thousands of dollars on the line before you ever sell a single slice of pepperoni pizza.
It is a massive commitment. You are stressed about overhead from day one.
You have these massive sunk costs that literally force you to be serious about the endeavor.
But now look at day trading. What is the barrier to entry there?
A laptop, an internet connection, maybe a few $1,000 and a brokerage account.
I could technically start trading while sitting on my couch in my underwear.
That is the reality. And because it is so incredibly easy to start, people treat it casually. They treat it like a hobby, or worse, like a mobile video game.
Oh, I see. So Aziz argues that this low barrier to entry is actually a massive trap.
It is the biggest trap. Because you didn't invest $100,000 in equipment, you don't feel the weight of the business. You open your laptop, click a few buttons, and just hope to make money.
If you ran a pizza shop like that, opening when you felt like it, not measuring ingredients, you'd be closed in a week.
Exactly. He even compares it to high-skilled professions like medicine or law.
Right, a doctor studies for years, goes through residency, passes board exams.
An engineer spends years in university. So why do we assume we can just sit down at a computer and instantly beat the smartest minds on Wall Street without any real education?
It is arguably one of the most competitive fields in the world, yet people treat it with less respect than a part-time retail job.
It is the arrogance of the amateur. We see the potential reward, the freedom, the money, and we just want to skip the hard work part.
But the author has a pretty crazy story about this, doesn't he? He didn't start out as this disciplined, stoic engineer trader.
Wait, he really didn't. He learned this the hardest way possible. And this brings us to what he calls the lucky fool syndrome.
Oh, the story is wild.
It is a story he tells about his very first trade. He was a complete beginner. He saw a pharmaceutical company, Equinox Pharmaceuticals, ticker AQXP.
And they had just announced some positive drug results.
Classic news catalyst. Good news, stock goes up. The stock jumped from $1 to over $55 in 2 days.
Just going completely parabolic.
Going vertical. So Aziz, not really knowing what he was doing, bought 1,000 shares at $4.
At $4. And it went to 55.
Well, he sold them just a few minutes later at over $10.
Wait, let me do the math. That is a $6 profit per share on 1,000 shares.
That is a $6,000 profit in a matter of minutes.
Oh my God. That is incredible. I would be over the moon.
And that is exactly the problem. He says it is the most dangerous thing that can possibly happen to a beginner.
I was going to say that sounds awesome, but you are saying it is dangerous. Why? I would take $6,000 right now.
Because he thought he was a genius. He thought, wow, this is easy. I just made $6,000 while drinking my morning coffee. I can do this every single day.
Oh, I see. You created a totally false sense of confidence.
Right. He didn't have a strategy. He just had dumb luck. He hit the lottery. And as he points out, the market will always punish arrogance eventually.
So what happened?
Within a few weeks, he had lost that entire $6,000 plus a significant amount of his own savings.
Because he was trying to replicate a lucky break without having a system. He was chasing that dopamine hit.
Exactly. That is the lucky fool story. If you win early on without skill, you are just being set up for a catastrophic failure later because you never learned risk management.
You just learned that gambling sometimes pays off.
It is far better to lose your first trade and learn to respect the market than to win and think you own it.
That makes a lot of sense. Okay, so that is lesson 1. Treat it like a business, not a casino.
Yeah.
Let us move to lesson 2, which fundamentally defines what we're even talking about today.
Right. Never hold positions overnight.
This is the golden rule that separates day trading from everything else.
Completely.
I think a lot of people get this confused. My uncle buys stocks and holds them for years. That is investing. But what about swing trading?
Swing trading is when you hold a stock for a few days or weeks to catch a larger trend. But a day trader, by Aziz's strict definition, is all cash at 4 p.m. when the market closes.
No exceptions.
No exceptions.
Why is he so strict about that? Is it just about being obsessive?
It is called the sleep test.
The sleep test.
Okay. Imagine you buy a stock today. You decide to hold it overnight. While you are sleeping, at 3 in the morning, the CEO gets arrested for fraud.
Oh, man.
Or a war breaks out in another country. Or the company announces terrible earnings. The market is closed, so you cannot sell. You are completely helpless.
You just have to sit there and watch it burn in the pre-market.
Exactly. You wake up the next morning and the stock opens 20% lower than where you bought it. You lost a huge chunk of money while you were unconscious.
That is the stuff of nightmares. I would be checking my phone constantly all night.
And for a day trader, that specific risk is just unacceptable. The primary benefit of this profession is supposed to be peace of mind.
Because you close your positions. You are in cash.
Right. If the world falls apart overnight, it doesn't affect your bank account one bit. You sleep soundly.
I love that.
Yeah.
You don't have to check your phone at 3 a.m.
Yeah.
But this also completely changes what kind of companies you can trade, doesn't it?
This is a crucial distinction. If you are an investor, you need to buy solid companies. Apple, Microsoft, companies that will definitely be here in 10 years.
But as a day trader.
Aziz points out that day traders can trade companies that are literally going bankrupt.
Really? Why on earth would you buy a company going bankrupt? That sounds counterintuitive to the whole business mindset we just talked about.
Because you don't care about the company's long-term future. You only care about the volatility today.
Oh, the intraday movement.
Right. If a company is going bankrupt, the stock price might bounce up and down violently during the day as people panic, buy, and sell.
And a day trader can make money on those tiny moves.
Exactly, and be out before the closing bell. You are trading the movement, not the company.
That is a massive mindset shift. We aren't marrying these stocks. We aren't even dating them. We are just grabbing a quick coffee with them.
A very quick espresso, yes. You are there for the price action, not the fundamentals.
Okay, so we have the mindset. It is a business, and we sleep well at night because we are flat cash. Now let us talk about the actual battlefield.
This is where it gets interesting.
Yeah, part 2 of our deep dive covers lessons 5 and 6. And the language here gets really intense. Lesson 6 says, we need to adopt a guerrilla warfare mentality.
I absolutely love this analogy. It perfectly describes the power dynamic in the market. It clears up the delusion that the little guy has any real power.
So who are the combatants here? Who are we actually fighting?
On one side, you have the institutional traders, the Goliaths.
Okay.
These are the massive investment banks, Goldman Sachs, Morgan Stanley, the hedge funds like Citadel, the high-frequency trading algorithms.
They're big guys.
Right. They have billions of dollars in capital. They have supercomputers physically located closer to the exchange just to shave nanoseconds off their trade times. They have armies of PhD researchers.
And on the outside?
There is you, the retail trader.
That's me.
Just you. You have a laptop, a generic internet connection from your cable company, and a tiny account, maybe $30,000.
Put that way, it sounds like a literal suicide mission.
Yeah.
How do you win a fight against a supercomputer with billions of dollars?
You don't fight them. That is the entire point of guerrilla warfare.
You hide.
Exactly. If a small army tries to meet a massive, heavily armed army in an open field, they get absolutely slaughtered. So what do? They hide in the jungle. They wait.
They look for a very specific opportunity.
Right. An opportunity where the big army is distracted or clumsy or overextended. They strike quickly, take what they need, and disappear back into the jungle before the heavy artillery can even turn around to fire.
So in trading terms, this means we aren't trying to move the market. We aren't trying to be the hero who predicts a massive shift.
No. You are just trying to take a little bite. You wait for the perfect setup, you enter, you take a quick profit, and you get out.
You do not stay in the trade hoping for a miracle.
The longer you stay in the market, the higher the chance the institutions will crush you. Aziz emphasizes that simply being better than average isn't enough.
You have to be smarter than the crowd.
You have to be nimble. You are a speedboat. They are an oil tanker. You can turn a lot faster than them.
Be the gorilla. I like it. But where do we actually find these opportunities? The jungle is a big place.
And that brings us to lesson 5, trade-only alpha predators.
Alpha predators. This is a great term he coined. What exactly is an alpha predator in the stock market?
An alpha predator is a stock that is moving completely independent of the overall market.
Okay, unpack that for me. Why does that matter so much?
Well, normally, stocks just follow the herd. If the S&P 500 or the Dow Jones is going up, 75% of stocks go up.
A rising tide lifts all boats.
Exactly. And if the market is crashing, most stocks go down. Algorithms link them all together. So if you trade a stock that is just following the market, you are literally trading against those algorithms. It is choppy, it is unpredictable, and it is incredibly hard to make money because there is no specific reason for that stock to move other than everything else is moving.
So we want the outliers, the rebels.
Yes. We want the stock that is shooting up even if the market is crashing, or the stock that is crashing while the market is booming.
And how do we find them? What makes a stock go rogue like that?
It needs a catalyst. Something major has to happen to that specific company to break it away from the herd.
Like what? What kind of news?
Earnings reports are the biggest one.
Oh, sure, quarterly earnings.
Or FDA approval for a new drug, maybe a merger announcement, or a massive scandal, something that generates huge interest and volume specifically for that single stock.
You mentioned volume. That is key, right? I feel like beginners ignore volume completely.
They do, and it is a fatal mistake. You need huge relative volume. Retail traders need liquidity.
Because we need other people buying and selling so we can actually get in and out of the trade.
Exactly. If a stock usually trades 100,000 shares a day, and today it has traded 5 million shares by 10 a.m., that is an alpha predator. That is where the action is.
It means everyone is looking at it.
And there's another term he uses that I really want to clarify because it sounds jargony, but it is super critical. Float.
Oh, yeah, he talks a lot about low float stocks. What does that actually mean?
This is pure supply and demand economics. Think of float as the actual supply of shares available to the public to trade.
Okay, so like how many slices of pizza are left?
Exactly. Now, Apple has a massive float, billions of shares. It takes a huge amount of money to move Apple's stock price even a few cents because the supply is just so deep, it is a heavy ocean liner.
Right, I can't move Apple with my $30,000.
No one can. But a low-float stock has a very small supply of shares. Maybe only 10 million shares are available total.
Okay, I see where this is going.
Now imagine some huge news comes out. Everyone suddenly wants to buy this company. High demand meets incredibly low supply.
The price explodes.
Exactly. It moves fast. It is like a game of musical chairs with 100 people and only one chair. The price squeezes up violently.
And that is where retail traders can actually beat the computers.
Because the volatility is so incredibly high that the algorithms sometimes step back and the gorillas, the retail traders, can make their move.
But it cuts both ways, doesn't it? High volatility means you can make money fast or you can lose it fast.
Very fast. Which brings us perfectly to part 3. If we are running around a jungle with gorillas and alpha predators, we are going to get hurt if we aren't careful.
Yeah, lesson 3 is arguably the core of the whole philosophy. Your primary job is to manage risk.
This is the most important lesson in the entire book. If a listener takes absolutely nothing else away from this deep dive, take this.
He says traders aren't in the business of buying stocks. They are in the business of managing risk.
Right.
That feels like a contradiction, though. Don't we make money by buying stocks?
No, you make money by not losing your shirt. He uses another brilliant analogy here, the scuba diver.
I love this one. It makes the concept so visual.
Imagine you are a professional scuba diver. You are exploring this beautiful underwater cave. There are exotic fish, gold coins, amazing coral.
Sounds great.
But what is the one thing you care about more than anything else? More than the gold coins?
My air supply.
Your oxygen tank. For a trader, your money is your oxygen. If you run out of money, you cannot trade. You die, financially speaking.
Right. A professional scuba diver checks their air gauge obsessively.
And a professional trader checks their capital obsessively. You have to protect your oxygen at all costs.
So how do we actually do that? Because just saying be careful is pretty vague.
It is vague. That is why he gives us a very specific mathematical rule, the 2% rule.
Okay, walk us through the math of the 2% rule. Let us say I am that retail trader with the $30,000 account.
Okay, let us say you have saved up 30 grand for your trading account. 2% of 30,000 is $600. That means on any given trade, the maximum amount you are allowed to lose, your absolute limit, is $600.
That seems really small, though. If I have 30,000, why can't I risk 2,000? I want to make big money.
Because of something called gambler's ruin and the brutal math of drawdowns.
Yeah.
If you risk $2,000, which is nearly 7% of your account, and you hit a bad streak of 5 losing trades.
Which happens, right?
It happens to everyone, even the absolute best pros. So you lose 5 times.
I am down $10,000.
You have just lost a third of your entire account. You are psychologically broken. You are gasping for air.
And it is hard to climb back from that.
It is worse than hard. Here is the kicker. If you lose 33% of your account, you don't just need a 33% gain to get back. You need to make a 50% gain on what is left just to get back to even.
Wow. The hole gets exponentially deeper the further you fall.
But if you only risked $600.
If I lose 5 times in a row, I am only down $3,000.
Exactly. You still have $27,000 left. You are still very much in the game. You still have oxygen. The 2% rule is entirely about survival.
It ensures that no single bad trade, or even a terrible string of bad trades, can blow up your account.
It keeps you in the game long enough to actually learn how to win.
That is powerful. But risk is only half the equation.
Right.
You can't just minimize loss. You have to have an upside.
You need a target.
Right. And lesson 4 gives us that target. Seek a minimum 2-to-1 profit-to-loss ratio.
This is how you make money even if you aren't right all the time. This is the batting average concept.
So explain the ratio for us.
It means for every dollar you risk, you must have the realistic potential to make $2. Let us go back to our example.
The $600 risk.
Right. If you are risking $600, meaning your stop loss is set there, you must have a logical target to make at least $1,200 in profit.
Why 2-to-1, though? Why not 1-to-1? Isn't 1-to-1 fair?
If you trade with a 1-to-1 ratio, you have to be right more than 50% of the time just to break even, especially once you factor in broker commissions and fees.
And being right more than half the time is hard.
Trading is incredibly messy. It is very hard. But with a 2-to-1 ratio, you can be wrong 40% of the time. Heck, you can be wrong 50% of the time and still be highly profitable.
That really takes the pressure off. You don't have to be a fortune teller. You just have to find the right setups where the upside is double the downside.
But here is the catch. Discipline.
Oh boy.
If you see a trade setup that looks really good, maybe you just feel the stock is going to go up, but the math on the chart only offers a 1-to-1 payout, what do?
You walk away.
You walk away. You simply do not take the trade. That is the discipline of the professional.
An amateur says, well, I think it will go up anyway.
And a professional says, the risk reward isn't there, I pass.
That is tough. Sitting on your hands is probably harder than actually trading.
It is the hardest part. It is really boring. But boring makes money.
Okay, so we have the risk rules down. Now we need to know when to actually press the button. Part 4 covers technical execution. Lesson 8 is, let technical indicators guide you, but not dictate you.
Right. Rule 10 in the book is literally indicators only indicate.
I feel like a lot of people fall into this trap. They load up their screen with charts, RSI, MCD, Bollinger Bands, and they look for some magic combination like, oh, the triple line crossed the green line, so I buy.
That is a recipe for absolute disaster.
Why?
Because algorithms are programmed to do exactly that, but they do it a million times faster than you ever could. If you are blindly following an indicator, you are just providing liquidity for a robot.
So the indicator is lagging.
Yes. Indicators tell you what has happened, not what will happen.
So how should we use them?
We use them for confirmation. We use them to find what Aziz calls confluence. He highlights a few specific tools he actually trusts.
Let us run through the toolkit. First up, candlesticks.
Candlesticks are the basic language of the market. They aren't just lines on a screen. They tell a story of the battle between buyers and sellers.
Can you give a specific example of what a candlestick tells you?
Sure. Take a hammer candle. It has a small body at the top and a long, long tail at the bottom.
What does that long tail mean?
It means sellers pushed the price way down during that minute, but buyers stepped in aggressively and pushed it all the way back up before the candle closed.
Oh, I see. It shows resilience.
Exactly. It shows the buyers won that specific round. You have to learn to read them like a book.
Next tool is support and resistance. But he has a very specific take on this, right?
Yes. He heavily prefers horizontal lines over diagonal trend lines.
Why is that? I feel like everyone draws triangles and diagonal lines on Twitter.
Because diagonal lines are totally subjective. You can draw a diagonal line to match whatever bias you already have in your head. Oh, if I squint, it touches here and here.
Right, it is wishful thinking.
But a horizontal line at, say, $50, that is a real psychological price level. The market remembers that price. It is totally objective.
Price memory.
Yes. Yeah. If a stock bounced hard off $50 yesterday, it is highly likely to bounce off $50 today because human beings look for round numbers.
That makes perfect sense. Okay, next one. And he calls this the most important indicator of all, VWAP.
Volume weighted average price.
And that is quite a mouthful. Break it down for us.
It is a mouthful. But here's why it matters more than anything else. The institutions use it.
The big guys.
Right. If a mutual fund manager needs to buy 1 million shares of Apple today, they get huge bonuses if they manage to buy it below the VWAP, and they get fired if they buy it too far above the VWAP.
Oh, wow. So it is like the true average fair price of the day that the big money actually cares about.
Exactly. And since the big money respects the VWAP, the price often reacts to it like a giant magnet or a force field.
So if the price crashes down to the VWAP, it often bounces.
Because institutions are automatically stepping in to buy at what they consider the fair price. Retail traders need to watch it simply because the whales are watching it.
Got it. So we have our tools. But tools are totally useless without a plan. Which brings us to lesson 9. Plan the trade and trade the plan.
Aziz says successful trading is actually incredibly boring. It is repetitive. It is not the constant adrenaline rush of a movie like The Wolf of Wall Street.
Walk us through his morning routine then, because he doesn't just roll out of bed at 9:29 a.m.
Definitely not. He wakes up at 5 a.m.
Ouch.
He exercises, he showers, he eats a healthy breakfast, he gets his mind completely right. He treats it exactly like a professional athlete preparing for a big game.
And then the real work starts.
Around 6 a.m., he starts scanning. He is looking for those gappers, the alpha predators we talked about earlier.
Filtering through thousands of stocks.
Right, trying to find the 3 or 4 that actually matter today.
And by 6:15 a.m., he has his final watch list.
And this is the critical part. Before the market opens at 9:30, he writes down a physical plan for every single stock on his list. And the plan must have 3 distinct things.
I'm taking notes here. What are the 3 things?
1, entry point. Where exactly am I getting in? 2, exit point. Where am I taking my profit? And 3, stop loss. Where do I admit I was wrong and bail out?
And he decides all of this before he even buys a single share.
He absolutely has to, because once you are in the trade, your pulse is racing, your emotions kick in, and your IQ drops about 20 points.
That's so true.
You cannot make rational decisions when real money is on the line and moving fast. You have to make the decision while you are perfectly calm and then just execute the plan like a robot when the bell rings.
Hope is not a strategy.
Exactly. If you are in a trade and you catch yourself saying, I really hope it comes back up, you have already lost. You broke the plan.
This leads us right into the biggest hurdle of all. The thing that probably kills more traders than bad math or bad stock picks. Part 5, Psychology and Endurance. Lesson 7 is Master Emotional Control and Self-Discipline.
Rule 11, profitable trading is emotionless.
Which is impossible, right? I mean, we are humans. We feel fear. We feel greed. We aren't Vulcans.
We do feel those things, but we have to recognize them and manage them. The absolute biggest enemy here is revenge trading.
Oh, man, I know this feeling from sports. You lose money in the morning, you get angry, and you just want to win it back immediately.
It is the worst thing you can possibly do. You just lost $500. You are mad. You feel stupid. You think, I need to make that back right now.
That you force a bad trade.
You force it, you bet bigger, you completely ignore your rules, and inevitably you lose another $1,000. Now you are just devastated.
It is a total downward spiral.
Aziz talks a lot about the superpower of being a good loser.
A good loser. That sounds like something a coach tells a kid in Little League.
In trading, it is a literal survival skill. The ability to take a small loss, accept it, and walk away without letting it ruin your entire day. He says, lose gracefully, take the loss, walk away.
There's a really visceral story in the book where he describes freezing up. He is staring at his keyboard, losing thousands of dollars, and he physically cannot move his finger to press the sell key.
That is the classic fight or flight response. The lizard brain, the amygdala, takes over completely.
And you just freeze.
Your frontal cortex, the logic part of your brain, just shuts down under severe stress. That is why you need the plan written down, and that is why you need massive amounts of practice.
Practice. Which brings us to lesson 10. Practice extensively in a simulator before using real money.
This is the barrier to entry that most people refuse to cross. They want to make money right now.
They just download Robinhood, fund it with a credit card, and hit the ground running.
But Aziz says you absolutely must spend 3 months in a simulator. Paper trading. Fake money.
3 months feels like a long time.
Think about the pizza shop analogy again. Would you open the front doors to paying customers before you ever practiced baking a single pizza, before you even knew how to operate the cash register?
No, obviously not. You would practice.
People think trading is different. It isn't.
But isn't it psychologically different with fake money? It doesn't actually hurt when you lose in a video game.
That is the main challenge. He says you must treat the simulator as completely real. If you blow up your simulator account, you would have blown up your real bank account. It is a harsh reality check.
He mentions specific software, too, like DAS Trader. That costs real money, right? Like $120 a month.
Yes. And people complain constantly. They say, why should I pay money to trade fake money?
It does sound a bit backwards.
But Aziz argues perfectly that paying $120 a month for your tuition is a whole lot cheaper than losing your $30,000 life savings in the real market just because you didn't know which button to press.
That puts it in perspective. It's just the cost of education. Cheaper than a college degree and way cheaper than a bankruptcy.
Exactly. If you can't be disciplined with fake money, you will absolutely be destroyed by real money.
Okay, so we have covered the mindset, the strategy, the risk, the tools, and the psychology. Let us bring it all together in part 6. How does this actually look in daily practice? The book details a few specific setups, like the ABCD pattern and the bull flag.
Right. These are the bread and butter setups. They are the practical application of everything we just talked about.
Let us touch on them briefly. What exactly is the ABCD pattern?
It is a pattern that relies entirely on patience. The stock shoots up at the open. That move is A to B.
And most amateurs chase it right there.
They buy at the absolute top because of FOMO, but the professional waits. The stock naturally pulls back and consolidates that as point C. It builds a solid base.
So point C is where you plan your entry.
Exactly.
Yeah.
Then, if it breaks out again, heading towards point D, you ride that wave. It is about not chasing the shiny object, but waiting for the object to come to you on your terms.
What about the bull flag?
That is a classic momentum play, usually for those low-flowed stocks we talked about earlier.
And one's moving fast.
Right. The
Yeah.
stock shoots up fast like a flagpole, then it goes sideways for a bit. That tight sideways movement is the flag. It is catching its breath.
And you buy the breakout.
You buy it as it breaks out of the top of the flag for the next leg up. It is very fast. Get in, scalp the profit, and get out.
And then there's the reversal. Some people call this catching a falling knife.
Well, the goal is trying not to catch the falling knife.
Right.
You wait for a stock that has crashed way too far, way too fast, but you absolutely do not buy it on the way down.
Because it could just keep falling.
Exactly.
Yeah.
You wait for a clear, undeniable indicator like that hammer candlestick we mentioned earlier that proves the bottom is actually in. Then you buy the bounce.
But again, none of these specific strategies work without the underlying risk management.
None of them. The bull flag will fail sometimes. The ABCD pattern will completely collapse sometimes.
And if you don't have your stop loss that 2% limit, the strategy doesn't matter. You still lose.
It all comes completely back to the 3 legs of the stool that Aziz talks about.
The 3 legs. Remind us what they are.
Psychology, strategy, and risk management. If you remove even one leg, the stool falls over.
Right. You can have the best strategy in the world, a perfect full flag, but if your psychology is weak in your revenge trade, you lose.
And you can have great psychology, you're totally calm, but if you don't have risk management and you bet your whole account on one trade, you go broke.
It is a totally holistic approach. You need all 3. And if you get it right, the lifestyle he describes sounds pretty incredible.
It is the ultimate allure. Being your own boss, working from home, no commute, the real potential to make $500 or $1,000 a day.
Aziz knows traders who make $2,000 a day consistently.
He does.
That is a huge amount of money. Even $500 a day is well into 6 figures a year.
It is, but it is earned. It is absolutely not free money. It is paid for with immense discipline, incredibly early mornings, and the emotional resilience to handle constant losses.
So as we wrap up this deep dive into how to day trade for a living, it really forces you to look in the mirror.
It really does. It raises the most important question for the listener. Are you looking for a lottery ticket, or are you actually willing to build a business?
The market will pay you if you are disciplined.
But it will ruthlessly punish you if you are arrogant.
You just have to master the boring stuff to get to the exciting rewards. Psychology, strategy, risk management. Keep those 3 legs steady.
And remember, even the absolute best traders lose. It is how you lose that defines your entire career.
A fascinating look into a really high-stakes world.
It truly is.
Thank you for watching, Elea. Please like, share, subscribe, follow up in the next video.